Most investors are making a huge mistake by ignoring the index funds I'm covering in today's video. Are you one of them? Now, I've been investing for over 20 years and I've learned that picking the right index fund or funds is one of the keys to building massive wealth. In this video, I'll show you 6 of the best Vanguard index funds to buy in 2025 and how they can make you a millionaire. Fund 1, the Vanguard FTSE All World ETF. This fund gives you exposure to over 3,600 companies from all around the world, from the US and Europe to emerging markets. The expense ratio is just 0.22%, meaning you keep more of your money instead of paying high fees. Out of 7, Vanguard give it a risk of 6, so this is high risk. If you're like me and intend to invest for the next 20 odd years, you can afford to go high risk. If you're late 50s, early 60s, you're probably going to go low risk to preserve your wealth that you've hopefully built up. Why is this a decent little pick? Because global diversification reduces your risk. If one country's market is down, others can balance it out, keeping your portfolio steady, the opposite of investing in individual stocks. Additionally, this fund includes stocks from a variety of sectors like tech, healthcare, finance and more, ensuring that your investment isn't just relying on one industry. A key feature of this fund is that it allows you to tap into companies that are leading the charge in innovation, while also keeping a strong foundation in stable, well-established businesses. The combination of growth potential and stability makes this fund a must for long-term investors. Now, before we go any further, I've got a little question. Would you be interested in a cheat sheet to help you start investing in index funds step by step, safely and with confidence? All you've got to do is type yes below in the comments. Fund number 2, the Vanguard FTSE Global All Cap Index. This one includes over 7,000 companies, even more than the first. So that's more diversification, which is really important for some investors. It includes smaller companies, which means higher growth potential, but also a bit more volatility. It's still a passive, long-term strategy, but if you want even more diversification, this is a strong choice. What's unique about this fund is that it doesn't just invest in the largest companies. It also includes small and mid-cap companies that have the potential for significant growth over time. Historically, smaller companies tend to outperform larger ones over the long run, making this an exciting option for those looking to maximize returns. Plus, the fund allows investors to capture market movements across the world in real time. Instead of focusing only on established economies, it balances exposure across different market segments, providing the opportunity to capitalize on emerging trends and industries. The slight increase in expense ratio at 0.23% is well worth the added diversification, in my humble opinion. Risk-wise, it's 5 out of 7, so slightly less than the previous fund. Performance-wise, I'm going to show you at the end because I want to compare all 6 funds against each other to see which ones have been doing the best. Fund number 3, the S&P 500 UCITS ETF. Now, let's talk about the most famous index fund in the world, the S&P 500 UCITS ETF. This tracks the top 500 companies in the US, including tech giants like Apple, Microsoft and Nvidia. If you'd invested £10,000 in the S&P 500 20 years ago, you'd have over £60,000 today, even after all the recessions, financial crisis and market crashes. And the best part, the fees are really low, just 0.07%. If you believe in the US economy and you believe the US dollar will remain the global reserve currency for the next few decades, this is probably the way to go. But why does the S&P 500 perform so well? It's all about the companies it includes. The US stock market is home to some of the world's most influential and innovative companies, from cutting-edge technology firms to long-standing consumer brands like Exxon, JP Morgan, Walmart, Netflix, Tesla and all the other big tech companies, etc. This fund offers exposure to businesses that have shaped the global economy and will likely continue to do so in the future. The reason investors flock to this index is its resilience. Time and time again, the S&P 500 has rebounded from economic downturns and continued its upward trajectory. This fund is perfect for investors who want a balance between stability and growth. Looking at over 100 years of historical data, tracking the S&P gets you, on average, 10% per year. Much, much better than holding your money in cash or a crappy savings account. Do you think 10% beats inflation? Yes or no? Let me know in the comments below. Fund number 4, the Vanguard FTSE Developed World ETF. If you like global investing but want to focus on developed markets, the Vanguard FTSE Developed World ETF is a brilliant choice. It skips emerging markets and only invests in stable, strong economies, with over 2,000 stocks in total, and a low fee of 0.12%. You might be thinking, why does he keep rattling on about the fees? I don't care about 0.2, 0.1, it doesn't matter. Well, I'm here to tell you it's hugely important. I've read loads and loads of books about index investing, like the Little Book of Common Sense Investing by John Bogle. And literally every single book mentions the importance of keeping fees low. This gets really important when you start really building wealth in time. And the odd 0.5% extra in fees cost tens of thousands of pounds when you get to them levels. That's my little rant about fees over. Now, just to be transparent, I wouldn't go for this fund as I like to invest in emerging markets because they include India and China, which have some awesome companies, some huge companies, and have very strong economies, obviously. I've added this fund because it gives you an idea of what type of funds are out there. Developed markets such as the US, UK, and Europe offer economic stability and well-regulated financial markets. This means that while the growth potential may not be as high as with emerging markets, the risks are significantly lower. For those looking for a lower risk global fund, this might be a smart pick. Fund number 5, the Vanguard FTSE Emerging Markets UCITS ETF. On the flip side, if you want higher risk but higher potential reward, the Vanguard Emerging Markets ETF invests in places like China, India, Brazil, and Taiwan. These economies are fast growing, and while they're more volatile, they offer huge upside in the long run. Emerging markets often provide access to industries that are just beginning to flourish, whether it's tech startups, manufacturing powerhouses, or newly developed consumer markets. While short-term volatility can be an issue, long-term investors stand to benefit from these rapidly expanding economies. It has over 2,000 stocks within it, and the ongoing charge is 0.22%. Fund 5 for me is better than Fund 4, but that's just my opinion. Fund number 6, the Vanguard Life Strategy 100% Equity Fund. This is my personal favourite, the Vanguard Life Strategy 100% Equity Fund, the fund I've invested into every single month since 2019. This fund is well diversified, tracking 10 different index funds across global markets. It's a brilliant, in my opinion, set it and forget investment that gives you exposure to everything within just one fund. What sets this fund apart is its allocation strategy. It's built to balance global exposure while ensuring investors stay in the market for long-term growth. It's perfect for anyone who doesn't want to pick and choose individual funds, but still wants to be well diversified. This has an ongoing charge of 0.22% and risk-wise is 5 out of 7, so quite high risk. To be honest, I've rattled through 6 of the best index funds in this short video. If you want to get more info on how to buy index funds, what platform to use, and much more, you can join my free investing community on School. The links can be found below in the video description. Now, before we wrap up, we're going to finish by comparing the 6 funds in terms of performance. Number 1, Vanguard FTSE All World ETF. Over the last year, you would have got 20% returns, and over the last 5 years, 68%, so really good. Number 2, the Vanguard FTSE Global All Cap Index Fund. Over the last year, you would have got 22% returns, and over the last 5 years, 75%, so even better than Fund 1. Number 3, the S&P 500. Over the last year, you would have got 26% returns, and over the last 5 years, 99%. This doesn't surprise me at all. I would expect this to be number 1, to be honest. Let's see. Number 4, Vanguard FTSE Developed World ETF. Over the last year, you would have got 20% returns, and over the last 5 years, 75%. Number 5, the Vanguard FTSE Emerging Markets UCITS ETF. Over the last year, you would have had 17% returns, and over the last 5 years, 20%, so not very good compared to the rest. This is why it's important to look at a number of funds and stack them up against each other. Number 6, the Vanguard Life Strategy 100% Equity Fund. Over the last year, you would have got 21% returned, and over the last 5 years, 67%. So performance-wise, you would have to choose the S&P 500. So what's the best Vanguard index fund for you? Let me know in the comments below. And if you want to see exactly how investing in just one index fund can make you a millionaire, have a look in the video description and you'll find the link for a video that tells you every step of the way. And if and only if you've taken value from this video all about index funds, hit the like button, subscribe, get in the comments. This really does support the channel.